2018 Advance Report for McGowanGroup Asset Management clients and NetWorthRadio.com listeners. I'm Spencer McGowan, your financial weatherman. Let's get started with the conditions. First, Standard & Poor's 500, big rally, had the February winter storm, and now we're sitting at a rebound, which is very, very interesting. One of the Wall Street Journal reports noted this week that the FANG index, Facebook, Amazon, Netflix, Google, plus there are actually 10 companies in this index. Notice the gain, 32% annualized all the way back to 2014 versus the S&P 9.25% annualized for the same time period. What it means is just a few stocks have accounted for this huge rally, and if Amazon or any of the others were to stumble, it presents a danger to the indexes. Not so much the broader market where there are still bargains, but for the overall index performance, that trading range that we mentioned, 26,500, 23,000 on the Dow in the month of February alone, that trading range could stay for an extended period, and the indexes may be in danger of not performing at the same levels going forward. We'll cover the solutions to that in this weekend's program, NetWorthRadio.com, with Spencer McGowan and Alex Stoleen. GE. This is a sad story. Jack Welch, famed for the Six Sigma management techniques that built General Electric. This week's headline, though, we said General Eclectic. Notice the trading levels are the same as the crisis. This is a long period going all the way back to 2000 where the stock was 60. This week touching closer to $15. That's a lesson for investors. Just because it's a great blue chip name like a Texas Instruments or a General Electric doesn't mean that it's going to continue to perform smoothly and safely. Value at risk of loss here, 75% over an extended period, almost 20 years. Wow. This is your read on the interest rates and the interest rate climate. What you can see here, 2008 crisis, buying treasuries was a good idea. Rates down, prices up. You fell from approximately 4.5%, 5% down to 2.5% at the low. We even went closer to 2% here in 2016. Notice since then, you've got duration risk on this thing that is much higher than the yield. So if your yield is 3.2% and your duration risk is 20%, if that were to go to 4.2, that's risk in the treasuries. We'll cover this weekend what parts of the fixed income markets are still relative bargains based upon par value and a superior yield above the treasury. Gasoline, just for fun, prices at the pump, wholesale prices at the pump, generally 50 cents to $1 more than what you see here. $1.76, go all the way back to 2008. You can see a high on the wholesale prices above $3.50, and people were paying as much as $5 for gasoline. This is still a disinflationary trend. What it means for the average investor, right now the inflation and the commodities are coming back, as you can see, but at the same time the longer term inflation trend for one of the base commodities is actually a deflationary trend. I'm Spencer McGowan, NetWorthRadio.com, McGowanGroup Asset Management. Join us each week right here on YouTube. Like us, and we've got some special interviews coming up on the extended broadcasts. We'll cover the details next week.